Investing in a retirement annuity is an ideal way to supplement your existing pension or provident fund if you are currently employed, or build a retirement nest egg if you are self-employed. A retirement annuity will provide you with some tax benefits along with a number of other financial advantages over the long term. You must hurry though if you still want to take advantage of these tax deductions, because the cutoff date is the 25th, Monday the 25th, and if you want to qualify for those associated tax benefits. Okay, so we're seeing more people coming on board. So while we're waiting for them to come on board, let me introduce myself. My name is Sean van den Berg. I'm an investment specialist here at PSG Wealth. My objective today with this webinar is to walk you through why you need to take advantage of these tax benefits and how you can go about doing it. So the topics for today, if I go bring my cursor in here, the topics, okay, the contents is what is a retirement annuity, what are the advantages, and I want to spend some time on choosing the underlying fund, and obviously just to touch on what we offer from the PSG asset management side. Okay, so what is a retirement annuity? RA is a flexible, smart choice, as I would say. The old style RAs had a single underlying asset or portfolio, and you as an investor had no choice. Okay, the best assets now is to hold a well-constructed portfolio of equities, and obviously over the long term, equities has given the best growth potential. And with the new RAs, as I say, you have the flexibility as an investor to move around and obviously have the greatest exposure to equities. So what's nice about the RAs that PSG offers, we have a large number of unit trust funds you can choose from, and I'll go into that in more detail just now. Excuse me. So what is a retirement annuity? It forms, obviously, it's part of the Pension Fund Act. It's an insurance product that pays out income, and that's the main thing you want to focus on when it comes to this kind of investment product, and I'll go into more detail just now. But the main thing about the RA, it should be a crucial part of any retirement strategy. So the main thing, and obviously the focus of today's webinar, is to show you how you save on your tax bill, and into more details in that in the next slide or so. So who can invest in a retirement annuity? It's not for everybody. So first of all, RAs is only available for individuals. You, as a trust, can't get involved in it, or as a company, you can't get involved with it. It's only available for individuals. So that's number one. So it's individuals who want to save for the retirement. What's nice about the RA is that the new RAs nowadays are more flexible. You can stop and start your contribution as and when you want to. That's number one. And number two, you have flexibility in selecting the underlying investment instruments. I can switch between a money market account into a balanced fund, into a equity fund, and so it goes on. But also what's great about these RAs is that you can have the investment proceeds paid to a beneficiary at your death. So you can select the beneficiary, and obviously the trustees of the fund will find out who are the best beneficiaries to pay to. So who's it not suitable for? Is anyone who needs access to savings before the age of 55. So if you're looking at your time horizon and less than that, and you need access to funds, then the RA is not the investment vehicle for you. There are other products to use, for example, the voluntary investment plan or unit trust that we offer. Okay, so just understand, as a trust or as a company, it's not available to you. So how do you save tax with the RA? So first of all, your taxable income is reduced up to a certain level, certain limits, and I'll explain that in the next slide. In other words, the receiver revenue starts becoming your partner. So first of all, the contributions are tax deductible, but also more importantly, you're not paying any tax on the interest or the dividends, as well as any capital gains on the growth within the RA. Okay, so over the long term, you compound that kind of growth, it obviously benefits you. So the main thing here is that you have incentive to make the RA the weapon of choice in your investment and retirement strategy. So you as an individual can invest up to 27.5% of your income in pension products, obviously with a limit of 350,000. And as I said on the next slide, go into more detail, and hopefully the slide will benefit for you, explain it to you in more detail. So this is, I think, is the most important slide of this presentation. So we've got two scenarios. We've got an investor that hasn't got an RA. His gross income in this scenario is 600,000 for the year, so it works out to about 50,000 rand a month. So he contributes 5%, and the company contributes 5%. Remember, we have a total of 27.5% per annum. So in this scenario, he's putting 60,000 rand, which is 10% of his 600,000 a monthly away. Okay. So that's 5,000 rand a month times 12 is 60,000. So that 600,000 less than 60,000, his taxable income is 540. Let me bring my cursor in here. There. So it's 540,000. Then he pays tax on that. So in that tax bracket, he's paying 97,000 rand plus 36%, anything over 410,000. So in this scenario, he's paying 143,859 rand in tax. And that's all going towards Eskom and to the potholes and all those kind of things. Okay, I'm just joking. But his annual net income in this scenario is 396,141 rand. Okay. Divide that by 12, you get a monthly net income of 33,000. Okay. So that is without an RA. Now let's say, for example, you're in a position where you can actually contribute. Remember, I'm saving only 10% here. Bring away 10%. But I've still got another 17.5% I can put away. In other words, I can still put 8,750 rand away into a retirement annuity. Let's say in that scenario, you can use that, and instead of wasting that money, you've actually budgeted it and you save that kind of money every month. So that 8,750 rand times 12, you're putting into a retirement annuity which equates to 105,000 rand. 60 plus 105, subtracted from your 600,000, your taxable income is much less. Okay, this is why I say you're parting with receiver of revenue. Okay, because they're going to come on board as your partner in this scenario. So in this scenario, yeah, my taxable income, the tax I'm paying is much less, which is nearly 38,000 if I worked it out right, if I remember last. 37,800 rand difference. I'm paying less tax, and I'm putting more away to my retirement towards my retirement. So my annual net income is 328,000, which equates to 27,000 rand. Yes, it's much lower. Okay, the difference in net income is 5,650 rand. But add those two together, I have a tax savings. Remember that those two numbers together equates to my 8,750 rand. The difference here is that the receiver is coming on board and saying, okay, we're going to give you a tax saving of 3,150 rand per month. Multiply that by 12, okay, and that's how you get to this number. Where was my notes here quickly? So 37,800. That times 12, you're going to get a tax refund at the end of the year of 37,800. And one thing you must note, you cannot take a tax refund and put it back into your RA because you maxed out already your 27.5%. Okay, so what you can do, and a prudent investment would be to put into a tax-free. So I put 33,000 rand every year from my tax refund into my tax-free investment plan. That's number one. And I still have 4,800 rand over to go on holiday with. I'm just suggesting you put it into a tax-free, but obviously you can take it a whole tax refund and go on a nice little holiday at the end of the tax year. Yeah. So as I say, hopefully this makes sense that with the RA, I'm parting the receiver, I'm paying less tax, and I'm getting a tax refund, and I'll have more towards my retirement at the end of the year. Okay. So I hope that made sense to you guys. Oops, sorry. Let's take it out of the way. Bring back my pin. Okay, let's move on to the next slide. So the main thing about the retirement annuity is there are certain restrictions. And number one, we have what they call a Regulation 28. Regulation 28 basically gives effect as part of the Pension Fund Act, and limits the extent to which the retirement funds, like a retirement annuity, may be invested in particular kinds of or categories of assets. So the main purpose or the main idea of the Regulation 28 is to protect you, the member, and your retirement provision from the effects of a poorly diversified investment portfolio. Okay, so this is done by ensuring that we're limiting the maximum exposure to more aggressive asset classes when investment funds selections are done. So the main idea here is for you to have sufficient income in your retirement. So the restrictions as such is you can't have more than 75% of your portfolio exposed to equity, 25% exposed to property. You can't have more than 30% exposed to offshore assets. Okay, so that is where the Regulation 28 fits into the whole thing, especially with retirement annuities. Now, one of the questions I got up just now before we started was from, I think it was Vessel, that said, is there a difference between a tax-free and an RA? Yes, one of the big differences is that RA obviously is affected by the Regulation 28, whereas the tax-free is not. However, the tax-free is affected by certain funds you can only be invested into, what they call clean class funds, in other words, funds that do not have any performance fees. But Vessel, our last month, we spoke about tax-frees. Maybe I can send you a link to that past webinar. Goes into more detail. That is the main reason, the main differences between the two of them. And obviously with the RA is I can only put in 27.5% of my income, whereas the tax-free, I'm limited to 33,000 Rand per year and a lifetime limit of 500,000. Okay. So I hope that makes a bit of a difference. Explains to you guys the difference as such. What are the contribution amounts? The minimum investment, lump sum investment with PSG is 20,000. I think this goes to most providers is 20,000. On the debit orders per month, we have a 500 Rand a month minimum debit order, or 1,500 per quarter, or 3,000 Rand half yearly. But also you have the flexibility to combine debit orders and lump sum. So what we call ad hoc payments. So that's how you would go about it, and obviously maximum out to 27.5% of your income. Okay. So how does the RA pay out? You can only retire from an RA after reaching the age of 55. So the idea here is when you retire at the age of 55, you can take 1/3 of the value of the investment as a single lump sum. You'll see on the next slide it's a maximum or up to 500,000. But the balance, so you can take 1/3 out. The other 2/3 must be used to purchase a living annuity. Okay. If the full proceeds is less than 247,500, you can take the whole lot all out. Okay. So what's important here, and this is where I said just now about the income. The retirement annuity is designed for retirement income payments. 1/3 of the value of the fund to maximum of 500,000 you can take as a lump sum tax-free. The other 2/3 must be purchasing a living annuity, and with that you can stipulate you want to withdraw between 2.5% and 17.5% of the investment as an income. The sweet spot right now with the current market conditions of giving around about 8% on the money market, the sweet spot right now is for people to take about 4%. Remember, this is decided on an annual basis. So when it comes to the anniversary date, you can chop and change it. But remember, 4% is what most people are taking right now. Okay. Members, you can access those funds before the age of 55 if the funds is less than 7,000, or in the event of ill health or disability, or you're immigrating, or obviously you see to be a resident of South Africa. Okay. What's also important is to understand that the RAs do not form part of your estate. In other words, it's not liable for estate duty. Very, very important. It's a nice thing to know that. Okay. Lastly, before we go into the advantages, highlight, especially for the young people, it might be on this webinar. People always think, the retirement, I'll sort it out later. Highlights for you, where if you're young and as soon as you start working, consider taking out a retirement annuity because time is on your side. So the main idea here is to start early. in this example, yeah, I just want to use a graphic assumption of 8%, which basically puts your money into a money market account. Okay, being very conservative, I'm going for 8% growth per annum. Whoops, sorry, let me go back. So John is the age of 23 now. Okay, he's contributing 800 Rand per month. Okay, he's got 42 years to go before before retirement age of 65. But he amasses 2.9 million on 800 Rand per month. Whereas John, he's only got 15 years to go before the age of 65. He has to contribute 8,750 Rand to be very much in the same ballpark as John to age 23. Okay. So the age of 65, they have roughly the same amount. But because John left it so late, okay, that's number one. But also John, at age 23, started earlier. He took the magic of compounding into consideration and obviously growth. So just a highlight for you. If you're young, start now. Okay. So let's get into the advantages, and I've touched on this before. First of all, main idea is to grow your retirement savings. You're supplementing existing pension or provident funds. This is a great tool to use. Remember, your contributions are tax deductible. Okay. Membership is independent of your employer. So you don't have to get permission from your employer. As long as you don't exceeding at 27.5%, you're not going to be penalized, but you want to contribute as much as you can, save as much as you can. So when you transfer from your RA to another RA, there's no tax payable. You're not going to be penalized or anything on that. You use a Section 14 transfer, but obviously the main idea is you want to preserve your funds and allows you for more growth on your investment. Okay. Just want to show you a table here quickly. Again, highlighting for you the tax benefits. Remember, you're paying no income tax, capital gains tax, or dividend withholding tax within the retirement annuity. And obviously, this contributes to higher growth potential. The RA contributions, again, are tax deductible, up to 27.5%, obviously with a limit of 350,000 Rand. So it's very simple. If you can understand these principles, that's what an RA is all about. Okay, so let's get to choosing the fund. Let's see how much time we've got now. Okay, we're going great guns. Cool. Choosing the underlying funds. As a starting point suggestion, I suggest go look at our funds list, A to Z. There's 9 pages of funds. There's about 450 funds. Not all of them obviously would qualify. Remember, we focus on Regulation 28 funds. So just to simplify it also, you can also use the funds A to Z. It's a search tool that you can use. You'll find it if you click on this link here, that you will find it on our page. And most RAs, remember, are restricted to Regulation 28, up to 75% of their funds to equity. I suggest as a starting point, go click on multi-assets. So you bring in the bond market and the money market and income funds and all that. In this scenario, this example, I clicked on all and I went global. And I clicked on search funds, and it spit out a list of funds for me. So I can go through this list. Okay, I can see what they are. But also what you want to do now is tick these little boxes, and I want to compare 5 funds together. Okay, so I want to compare, for example, balance funds. In this scenario, I'm looking at PSG Balance Fund E, and I selected I think about 2 or 3 other ones. In this scenario, I selected Allen Gray Balance Fund, Coronation Balance Fund, and the PSG Fund. What's important here is I want to compare performances, fees, and risks. Okay, so that helps you go through the selection criteria. And once you got your list down to about 5 or 6 funds, from there you can go back to. If I go back to this list here, click on these on the name of the funds, especially over here, and you'll be able to open up what we call the fund fact sheet. Learn more about the company, what they're focused on and things like that. Learn more about the philosophy, who are the fund managers, etc. Okay, the more you know about the fund that you want to get involved in, obviously you're betting the odds in your favor. Okay, so that's a process you can use to choose funds. Use the 2 tools, the funds A to Z list, the funds list, and also obviously the fund fact sheet to help you make a more informed decision. Okay, which funds to choose for your RA. And then just to highlight for you quickly, PSG Asset Management Funds, there are 4 that qualify as Regulation 28. Those would be the PSG Banner Funds, the Diversified Income Fund, and the Money Market Fund, as well as a stable fund. These are all Regulation 28 compliant. Yes, there's a tool on our website, Regulation 28 calculator. That's where you're going to build your own funds. But the problem with that is that if you exceed those limitations, you'll be alerted by the system and say you got a year to rectify the funds. So you'll have to you have to switch into other funds that are compliant. I just find it much easier to go choose the funds that are Regulation 28 compliant already. Okay. So I hope that it helped you guys. Let me just go into why PSG funds, and this is another big advantage why you want to use PSG funds. So if you're using PSG funds, obviously the admin fee is much lower. Yeah, we're talking about 0.35% for the first 1.5 million, as opposed to non-PSG funds, which is 57.5. That's 0.205 basis points. Works out to a lot over the long term. You compound that, and I'll show you in the next example. You take that, I'm taking PSG balance fund, we just spoke about now, versus another, call it another balance fund. The value of the portfolio is R1 million. You can see the funds are very much, very similar. The admin fee is very similar. You can see that's much lower, by the way, as I was talking about just now. Net fee, but you can see the difference here between the fees works out to 1,320 Rand. Okay, take that. And that potential cost saving, you take it and you invest that over 6% over the long term, and you can see over 30 years, equates to nearly 104,000 Rand. That's a 6% growth. If you're looking at 16% growth over the long term, and it is 700,000. So that savings just on fees is a big benefit to you. Okay, so something to take into consideration when you're choosing your funds. Consider PSG funds also. So just quickly summary before we get into the questions you guys might have. The main idea here is take advantage ahead of the tax season. Okay? Your RA contributions are tax deductible. Remember, Monday the 25th of February is our deadline. Remember, we still got 48 hours before the cutoff. So the funds have to be with us by the Monday the 25th. And this obviously, if you take advantage of the tax year, equate to higher growth potential over the longer term, gives that peace of mind that your retirement is in place. So partner with PSG Wealth, bottom line. Okay, so if you haven't got an RA with us yet, consider opening up an RA, go online, click on that link. You'll be able to register for it online. If you need some questions, please contact us. We're there to help you. If you find that doing it yourself is too intimidating, we've got over 200 financial advisor offices across the country that's also there to help you. Okay, so let's see what questions you guys have. Cool, let me just maximize this out. The lifetime limit is 500 Rand towards the RA, correct? Yeah, Vickers, to my knowledge, yes. Okay. Mr. Patel, what happens to your funds if you decide to immigrate? Obviously, if you decide to immigrate, you can take all the funds out if you want to, obviously with tax and things like that beforehand. Cool. Let me just tell you the question. Another question came in here. Hannes, how do you keep track of all the 350k limit? It's not like the tax-free where you're going to be penalized and be taxed over anything over the limit. Anything that you do put in when you do retirement, obviously that lump sum together with the excess payments will be paid out to you. But I think the best thing to do is just keep track for yourself how much you're contributing everywhere. Okay. Here's another question from Johan. I'm almost 65 years old and due to retire in August. What is the process to access the lump sum payment and how do I create the living annuity? Okay, awesome question. So first of all, on our website, there's a retirement form that needs to be completed, number one. Number two, obviously, we need to open up a living annuity account. In that process, we apply to receive a revenue for a tax directive. And then obviously with the living annuity, you need to decide between 2.5% income and the maximum is obviously 17.5% of the capital be paid to you as income. as I mentioned just now, the sweet spot right now is around about 4%. Okay. What you must understand is you can also allocate that the living annuity gets paid out to you, that income gets paid out to you either monthly, quarterly, or on an annual basis. Just understand also that PSG pays out the living annuity every month on the 25th of the month. Okay. So if you want to obviously revise the income decision or your the amount, you can only do that once a year at the anniversary date. Then obviously that lump sum gets paid to you in cash into your bank account. We do not pay to any third parties. So obviously we pay that lump sum out to you after the tax is deducted. So we deduct the tax beforehand. I'm just reading, you guys are giving me a lot of questions here. Great. Christine, the 30,000 per annum, no, that's for the tax-free, Christine. It's 33,000 Rand per annum is the lump sum maximum you can put into a tax-free. Okay. The retirement annuity is 27.5% of your income per year. So no, don't get confused between the two. 27.5% of your gross income that you can put into a retirement annuity. That's obviously if you don't have a pension fund or a provident fund. Honest, I'm not a financial advisor, so I can't really answer your question there. When I hit 55, should one start a pension or keep on saving? Depends if you need the money, you know. So I can't really answer that question. Pleasure, Christine. Okay. Okay. Cornell, yeah. Obviously, if you're buying direct share investments, there's no tax advantages. Okay. So trading direct shares is a totally different advantage. That's why the main idea is to invest into RA indirectly through RA into equities. You have a tax benefit. Okay. Vessel, pleasure. Okay. So I hope that answers your question there. Well, some guys are bombarding me with questions today. Awesome. Graham, I'm not 100% sure what you mean there. Does this apply to living annuity? I need some more information from you. Sorry, there's lots of questions here. Yeah, it looks like all of it. Informative. Is that age limit? Good question, Sean. What is the age limit on getting an RA? Yeah, I think there's no age limit, but I think a lot of people will be thinking, can I register an RA for my 5-year-old daughter, for example? And to me, the main thing there doesn't make sense because the 5-year-old doesn't have a tax number, number one, and it's not a taxpayer. So who is getting the tax savings? So there's no tax limit, tax age limit. I'd suggest that when you start working, and as soon as you do, is open up or register for a retirement annuity. Hopefully that's what you mean. Yeah, Shanae, you can get a RA at the age of 60. There's no tax, there's no limit on that. No. Obviously you want to take it if you're still working and you're still paying tax, then take advantage of it. What is the difference between a retirement annuity and a living annuity? So obviously when you first, the RA is when you start contributing towards a retirement. And once you get to the age of retirement of 55 or before, or 55 is when you can start taking the money out. But let's say you get to the age of 65, you convert the RA into a living annuity, Graham. So to pay out a lump sum, and a living annuity gives you that monthly income. But the income comes from your RA that you contributed towards over the years. I hope that makes sense. Okay. If I have an existing RA, can I switch that to a different company? Yes. It's what they call a Section 14 transfer. Hopefully transfer that to us. Okay. Looks like that's all the questions. Wow. Thank you very much. Okay. Awesome. So guys, I appreciate all those questions. Any other questions you guys might have, just you're welcome to contact us. There's our contact details. Sean VDB at phg.co.za. Drop me an email and I'll gladly answer questions to you guys. As I said, this presentation will be sent to you, as well as a PDF of the presentation. And yeah, next month we'll be going more into the equity side again. But thank you very much for being on this webinar today. All the best. And until next time, keep well. Bye for now.